Health savings accounts, or HSAs, are one of the most lucrative retirement vehicles available. Stay tuned and I'll explain why. What's up guys, I'm Josh and this is Budgeting with Butler, where we talk all things personal finance. With healthcare open enrollment upon us, I felt it would be suiting to make a video regarding HSAs. And make sure to watch this one all the way through because I'm going to be sharing some really important HSA information that you're not going to want to miss. So today we're going to talk about exactly what an HSA is, why you should or shouldn't get one, and who is and isn't eligible for one. Health savings accounts are a relatively new type of savings account, which were created in 2003 by the MMA. No, not that MMA. The MMA we're talking about here is an acronym for the Medicare Modernization Act, which just happens to also be short for the Medicare Prescription Drug Improvement and Modernization Act. The federal government just loves their acronyms, and they have one for just about everything. In 2003, President George W. Bush signed the MMA,
and you're working hard to put food on your family,
which included a new Medicare benefit which assisted senior citizens in paying for their prescription drugs. While the MMA was signed in 2003, this particular benefit did not go into effect until 2006. But to stay on track with our video topic here, this act also introduced health savings accounts as an option for individuals and families to save for medical expenses with pre-tax money. HSAs have largely replaced MSAs, or medical savings accounts, which HSAs closely resemble. MSAs themselves aren't even that old, stemming back to the 1990s. The thing about these MSAs is they were reserved for self-employed individuals and small businesses with fewer than 50 employees. These older types of MSAs are now known as Archer MSAs, named after Congressman Bill Archer of Texas, who was the sponsor of the HIPAA amendment, which created these types of accounts. There are currently no financial institutions opening new Archer MSAs. Out with the old, in with the new. The implementation of HSAs opened up these types of tax-advantaged healthcare accounts for anyone who is covered by a qualified, high-deductible health plan, or HDHP for short.
Why would I even want an HSA? Wouldn't it be better if I just put my money in a 401k and an IRA?
So, first things first, let's talk about the benefits the HSA has to offer. The largest benefit is that you can sock away pre-tax money into this account, lowering your taxable income. You can then use the money in this account to pay for all kinds of medical-related expenses, even things that aren't covered by insurance at all. Perhaps you want to get LASIK, or maybe your child needs braces, or maybe you want to get Invisalign. You can even use this account to pay for things like over-the-counter medicine. A pro tip is you can use a credit card to pay for these items, get the rewards points, then submit your receipts for them to your HSA, and then get reimbursed. Using your HSA account to pay for things like this that may not be covered by insurance could save you a significant amount of money, especially if your household income falls into one of the higher federal tax brackets. This account can be used to cover expenses for you, your spouse, and your dependents. But just because you have a funded HSA doesn't mean you have to spend it. Those who may benefit most from HSAs are healthier individuals who really never go to the doctor. What's up guys? If you're finding this content valuable or perhaps entertaining, please consider destroying the like button down below. So if you find you don't really go to the doctor much, you may consider enrolling into a high deductible health plan so you can take advantage of the HSA contributions. Another benefit of HSAs is the money within your account is never going to expire like that of an FSA. The money you save will always be there, either until you use it to pay for qualified medical expenses or you withdraw it. And speaking of withdrawing it, yes, you can withdraw this money for non-medical expenses once you hit 65 years old. But if doing this, you will have to pay ordinary income tax on the money you withdraw. Whereas if you use the money for qualified medical expenses, it will not be taxed. If you withdraw funds before 65 years old that aren't for qualified medical expenses, these funds will be taxed at your ordinary income tax rate, and you'll incur a 20% fee on top of that. So it's highly recommended that you adhere to the rules of the HSA. And while HSAs are called savings accounts, in reality, they are investment/retirement accounts. You're able to invest the money that you've saved inside of your HSA, taking advantage of years or decades of economic growth. This right here is why these types of accounts are especially important for those who are young and healthy, those who don't spend much money on healthcare. This is why many financial professionals tout this type of account as one of the most lucrative investment vehicles available.
Ooh, that actually sounds pretty sweet. How do I get started?
So generally, if your company provides a high deductible healthcare plan, or HDHP, chances are they'll have a preferred HSA provider. However, this doesn't always mean you have to go with the provider they choose. Talk with your company and see if you can use the HSA provider of your choosing. They may allow you to give them your personal HSA account and routing numbers so they can take pre-tax money out of your paycheck to allocate toward your HSA. Another really important thing to understand about HSAs is that when you leave your employer, you take the HSA with you. Also, it's possible for companies to not offer an HSA, even if they do offer a high deductible healthcare plan. And this is why it's important for you to know exactly what constitutes a high deductible healthcare plan. Here in the United States, an HDHP must have a minimum deductible of $1,400 for individual coverage or $2,800 for family coverage. It must also have maximum out-of-pocket expenses of $7,050 for individual coverage or $14,100 for family coverage.
Oh, that's awesome. So how much can I contribute to my HSA?
Great question. The maximum yearly contribution for HSA accounts for 2022 is $3,650 for individual coverage and $7,300 for family coverage. This is an increase of $50 for individual and $100 for family compared to the 2021 limits. Also, if you're taking advantage of an HSA and you're over 55 years old, you can contribute an additional $1,000 per year in catch-up contributions. And also, while there is a yearly maximum contribution limit, there is no annual lifetime maximum. So there is no cap on how much you can accumulate within your HSA. An important note is that employers will sometimes provide employees with partial funding of their HSAs. So that's definitely something to keep an eye out for. I like free money, and I would imagine most of you do as well. So to be eligible for an HSA, you must be enrolled in a qualifying high deductible healthcare plan like we've mentioned earlier in the video. However, there are certain things that can make you ineligible to take advantage of an HSA. And these are really important to pay attention to so you don't get tripped up the following tax year. First, you must have no other health coverage except what is permitted by the IRS. Second, you must not be enrolled in Medicare. And third, you cannot be claimed as a dependent on someone else's tax return. So number 2 and 3 are pretty straightforward, but let's revisit number 1. No other health coverage except what's permitted by the IRS. Now, I'm going to mention some of the other health coverage items that will deem you ineligible for an HSA, but please make sure to read the IRS publication linked in the description below before attempting to enroll in an HSA. First, your spouse cannot have another healthcare plan that also covers you. Next, if you have a prescription drug plan that provides benefits before your HDHP deductible is met, this makes you ineligible for an HSA. And finally, if you have a health FSA or HRA that pays or reimburses qualified medical expenses, you generally cannot contribute to an HSA. And this is exactly what my wife and I are currently dealing with. We're changing health insurance for 2022, and we currently have an FSA which has about $1,000 left in it. But we want to contribute to our HSA next year. In order to do so, we must use that remaining $1,000 before the end of this year in order to be eligible. The nice thing is we can use our remaining FSA funds for all kinds of stuff. Over-the-counter medicine, thermometers, weight scales, etc. So if you're in the same boat, you can go to FSAstore.com, which pretty much only sells things that are FSA eligible purchases. So as you can see, opening and contributing to an HSA does require some forethought and planning.
Oh, so what's the catch?
Well, if we're trying to see what the downside of HSAs are, it would really be the fact that we must be enrolled in a high deductible healthcare plan. Since your deductible is higher, it means you'll have higher upfront healthcare costs than a non-HDHP plan. You'll have to assess your available healthcare plans and see whether an HDHP plus an HSA is worth it when compared to a non-HDHP. Another thing to note that I didn't mention earlier is that your HSA funds cannot cover healthcare premiums. Healthcare premiums are the cost of the healthcare plan, which is generally taken out of your paycheck pre-tax. If you do decide to go with an HSA, it's important to realize that by simply contributing money to it does not mean that money will be invested automatically. If you foresee medical expenses in the near future, you may want to hold off on investing the money or keeping part of it liquid in case the markets have a downturn in the short term. But if you are in a position to do so, it may be beneficial to pay for medical expenses out of pocket so you can let your HSA grow as much as possible over the next few decades. HSAs usually have a minimum account balance requirement before you can invest. Depending on the HSA provider you choose, you may have access to different investment options. If I were opening a new HSA, I would likely go with Fidelity, as I believe they have solid investment options and I believe in the company. And now, I love HSAs, but I wouldn't put all my eggs in one basket. I believe they're a great supplement to other retirement accounts, such as our 401ks and IRAs. Each of these vehicles have their unique benefits, but also their own drawbacks. With that said, this is not financial advice, so please do your own research when choosing a provider. So hopefully I've answered some of your questions regarding healthcare savings plans. Feel free to head down to the comment section below if you have any questions or concerns. I make personal finance videos here on YouTube, so if you'd like to see more, consider subscribing. Peace.